In 2017, the Indian government overhauled its tax structure overnight with the rollout of the Goods and Services Tax, or GST. This triggered a chaotic restructuring of the internal economy that left millions of small business owners in the dark. For decades, the backbone of local trade was mental math and the kata, a physical, handwritten paper ledger system. The new, rigorous GST reporting requirements rendered these traditional transaction rows obsolete instantly. Merchants faced a technological void. Existing enterprise software was built for highly trained accountants, not local shopkeepers. Meanwhile, modern cloud-native applications required a constant, reliable internet connection, a luxury many street-level shops simply did not have. A sprawling, deeply informal market of millions was mandated by the government to digitize their daily operations, yet they lacked a viable, accessible tool to actually do it. Enter Vyapar. Launched right in the middle of this transition, its first iteration was a targeted digital utility built specifically to solve the immediate panic of generating a single GST-compliant bill. To get merchants to actually use it, the developers made a counterintuitive architectural choice. They ignored the global trend of web-based software and built an offline-first application, restricted entirely to native Windows and Android devices. Instead of pushing everything to a remote server, this architecture stores sensitive financial inputs locally. For merchants terrified of data theft, this provided physical ownership. To prevent loss, it automatically backups to Google Drive only when it detects a stable internet connection. By explicitly rejecting the standard cloud-only mandate of modern tech, Vyapar eliminated the psychological barrier to entry for millions of tech-hesitant shopkeepers. But generating a tax-compliant bill was only step one. A typical Indian kirana, or neighborhood grocery store, is a high-volume environment where transactions happen in seconds, making speed and mobility critical. Printing paper receipts was slow and ate into tight profit margins. The developers quickly rolled out a patch integrating WhatsApp, allowing shopkeepers to share digital invoices directly to a customer's phone the moment a sale finalized. They followed this with a multi-device sync engine to solve a persistent physical constraint. A hired cashier could now ring up items on the main shop desktop, while the owner monitored inventory and cash flow remotely from their Android phone. These specific updates transformed the software into a real-time communication network, linking owners, staff, and customers. As the user base grew, a new problem emerged. Different retail sectors require entirely different inventory logic to survive. The way a hardware store categorizes tools is vastly different from how a pharmacy operates. To fix this, Vyapar rapidly released industry-specific patches. They added automated batch numbers and expiry date tracking for pharmacies, and built a bill of materials feature to help small manufacturers calculate the conversion of raw materials into finished goods. They also integrated full barcode scanning and a dedicated point-of-sale module to keep up with high-speed checkout counters. Yet, one stubborn bottleneck remained. Even if a shop digitized its sales, receiving new inventory meant staring at a physical paper bill from a wholesale vendor and manually typing every single item and price into the computer. To eliminate this manual labor, the team introduced optical character recognition, or OCR, for purchase bills. OCR is a technology that identifies printed text within an image and converts it into machine-readable data. Now, a user simply photographs the vendor's physical invoice. The software scans the image, extracts the text, and automatically populates digital spreadsheet rows to update stock quantities without a single keystroke. By automating the ingestion of raw data, Vyapar destroyed the final, most tedious barrier to maintaining a perfectly accurate digital inventory. Even with perfectly managed inventory, merchants faced a recurrent monthly chore, taking their unstructured digital data and trying to hand it over to their chartered accountants for official tax filing. In late 2025, the company made a strategic pivot to solve this exact handoff by acquiring Suvit, an AI-powered accounting automation startup. The resulting launch of Vyapar Tax One created a two-sided ecosystem, allowing the software to serve both the shop owner and the tax professional simultaneously. This new AI bridge automates the GST reconciliation process. It takes the merchant's daily transaction data and instantly translates it into the strict, formatted documents required by auditors. With this acquisition, Vyapar embedded itself as the invisible connective tissue, linking India's informal street-level economy directly to official government regulators. This chart shows the financial reality of executing such an aggressive growth strategy. Maintaining a team of over 1,300 professionals to support these low-cost tools has driven a high cash burn rate, resulting in a reported 63 crore rupee loss for the fiscal year ending in 2025. However, plotting their scale on the same chart reveals the vast reach offsetting that burn. The platform has successfully onboarded over 10 million businesses worldwide, generating 130 crore rupees in annual recurring revenue. Instead of launching a monolithic, finished product, the company utilized an iterative, patch note approach, identifying one specific local friction point at a time, fixing it, and quietly assembling an enterprise-grade network from the ground up. Vyapar succeeded because it didn't force Silicon Valley's operating ideals onto Indian MSMEs. It simply built software that learned how those small businesses actually work.